Dan, I'm going to pass it over to you, and you can introduce yourself and you're a GM there.
Yeah, fantastic. Thank you, Mike. And look, apologies to everyone in the room. I was planning to be over there, but had more important things to address at site this week, and knowing how the weather's turned in Toronto at the moment going into November, and it's a lovely 30 degrees out here and sunny on the drive in, it probably worked out quite well. But I'm currently the interim CFO and Chief Development Officer of Metals Acquisition. To my left over here, I've got Rob Walker. Rob is the GM. Just as a way of background to myself, for those of you that haven't met me, I started my career in investment banking in Sydney, and then worked in the Northern Hemisphere for about 15, 16 years. Got to know Mick McMullen, who's the CEO of MAC, quite well during those years. Mick, obviously, as some of you may know, was the CEO of Stillwater, which is a company that I advised in their transaction with Sibanye, and also Detour. And so during the pandemic, Mick and I came up with a fantastic idea to start up a mid-tier mining company via vehicle, using this sort of SPAC market. And the rest is history, and I'll go into more detail during this presentation on that, but I think it's probably a good opportunity to give Rob an opportunity to introduce himself to the room.
Yeah, thanks, Dan. Rob Walker, the current General Manager for CSA Mine and Metals Acquisitions here in Cobar. My history is quite colourful from top to bottom. I started out as a tradesman many, many years ago, transitioned into mining, was an underground mine operator for approximately 6 years, and then got myself into the management stride. So I became from the top to the bottom through mining operations, predominantly in Mount Isa Mines. I transitioned out of Mount Isa Mines, where I left after steering George Fisher Mine for about 4 years as the mine manager. I transitioned out into some open cut operations. I've been in mineral sands as a general manager. I transitioned the Rosebery mine down in Tasmania here in Australia for MMG, out of pretty precarious situations there for a couple of years. Transitioned through to Aurelia Metals here in the Cobar region, and now with Metals Acquisition as the GM here. My career stems about 30 plus years in mining and trade backgrounds.
Fantastic. I'll try and share this screen, and apologies for if there are any hiccups here on the technology. It is quite unique to be presenting to a screen, knowing that there is a full room of people there, but I will try and get this open. Hopefully you can see that.
Yep, we can see it.
See it? Fantastic. Thank you. Okay, so I'll go through the slides. So Metals Acquisition, we're listed on the New York Stock Exchange with the symbol MTAL. As I gave background earlier, we decided probably 2 years ago that there was a real gap in the market, if you like. As an investment banker, I covered a lot of growth miners, so basically helping smaller cap mining companies grow into larger companies, whether it be via M&A or financing or acquisition of projects. That was my area, focused largely in the Northern Hemisphere, so in EMEA and the US and Canada. So we decided that we would embark upon this journey to try and create a mid-tier miner. Worked with a city to raise capital on the NYSE via a SPAC, so basically a cash box, and looked at about 80 assets in total in a broad range of jurisdictions, largely focused on jurisdictions that are stable and that we knew would be financeable in the market. And ultimately, we had discussions with Glencore about a broader transaction, but honed in on CSA. And CSA largely to us was a very attractive proposition because we knew for a long time that CSA was a high grade, high quality mine, but that probably needed more focus and needed better management. We embarked on that process and were successful in acquiring the mine, albeit through a very lengthy process. Our board and management that we put together as part of the transaction and as part of this vehicle are largely guys that have been in the industry a very long time. There's a lot of connection between board and management historically as well, which is incredibly helpful. Our current chair is Patrice Merrin, who also for a decade was on the board of Glencore for a significant period of time. We, as part of the SPAC transaction, we raised a PIPE. Our register is largely anchored by 6 or 7 large funds. One of them includes Glencore. Glencore decided to maintain equity in the vehicle, largely because they could see that through a focused effort and the management team that was assembled, that there is the potential for considerable upside over time. And so their view was that, getting behind us and supporting us as a minority investor made a lot of sense, and particularly from a return perspective. We launched and closed the deal in June. I'll go on to the funding. So in terms of our capital structure, as you can see there, we have 50 million shares on issue. There are a number of warrants that came as part of the SPAC transaction that over time will provide cash to MAC and at various strike prices there. We have about 205 million of senior debt through the relationships that we have over time. We've got a very robust lending syndicate. I've just been through the Q3 update with the banks who are very happy with how we're tracking. BMO, Scotia, National Bank and Citi are the banks on the senior. Sprott have provided us a MES facility of 135 million. And we have the silver stream and the copper stream, as you are probably aware from the presentations today with Osisko. And that, for us, was a very, very important part of the transaction. I think from anyone who knows anything about SPACs will understand this concept of redemptions and the need to have a backstop facility in place because as you're closing a transaction, particularly a transaction like the transaction we embarked on, where you're fully funding an asset acquisition rather than reversing into a vehicle as a valuation exercise. We were given a lot of proposals from various hedge funds and funds that operate in the SPAC industry around backstops. And one of the things that is notorious in the SPAC industry is that a lot of these backstops ultimately put a lot of pressure on your equity value over time, and are highly structured, and there's real potential for significant damage to the capital structure if things turn against you. And we, at the time, trying to close the transaction, had various conversations with counterparties around coming up with something that was a little bit more aligned with more agency, something that made a lot more sense and was longer term for the transaction to fill that final gap. And hence, after a few conversations with Mike and the team at Osisko, we came up with a copper stream that was done on obviously favourable terms for Osisko and frankly for us. But that was a key element in allowing us to close the transaction along with the PIPE. And frankly, that was only made possible through the strong partnership that we have with Osisko, and the strong partnership we actually want to have with Osisko on an ongoing basis as we try to grow the company. And it's something that I didn't really touch upon initially in the first slide, but one of the things that we are very focused on is growing this business. This is something that we want to build over time into a real mid-tier company, especially with the support of our key shareholders and with our key partners such as Osisko. And the sort of view from our standpoint is that, starting with a foundational asset like CSA, which is a high quality asset, and obviously in production, cash flowing, and has a long history with enormous potential in terms of the resource, is a great way to start that and grow the company from that base. So I won't go into a lot of detail here. I know that there's probably a lot of you in the room who have either spoken to Mick or I, or actually even been to site, so I won't go into great detail here. I think as a very high level overview, CSA has been operating for a long period of time, well over, is it
58 years in operations, I guess, in production, and 158-year history, just over 150 years history actually from discovery.
Yeah, so this is a mine that's been here for a long time. It's very high grade. It's in a great jurisdiction, both in terms of permitting. So local, like the permitting here is done with the Cobar Shire Council. It doesn't require state or federal permitting. It's in a region that's very well understood. There are a number of miners here in the region that have deposits in the region, and it's something that, on the basis of what we've seen during our due diligence, has a ton of potential for further growth both in and around the ore body. Let's skip over that. In terms of CSA itself, it is a mine that has a very small footprint. It's actually, if for anyone that has the opportunity to come out here or have the opportunity to come on one of our site visits, you'll notice that for a mine of its size, it has a very small footprint, and everything is well put together in the area. I'll let Rob explain the footprint and where everything stands here, just to give you a bit of context as well.
Yeah, thanks, Dan. Look, as Dan was indicating there, the mine itself has a significantly small footprint in terms of geographic surface areas. It's an extremely large mine underground. It's quite deep. It's quite hot. However, as you'll see from the current slide on the screen there, possibly the largest piece of infrastructure we've got will be our tailings facilities, which is on the right-hand bottom side of your screen. As you can see, still well within the mining footprint, the lease areas. The surface areas we indicate and keep indicating is significantly small on the basis of, if you take into account other jurisdictional mines around the Cobar area, our surface footprint is extremely small and has no intention of getting any larger, with the exception of some raises in our TSF facilities.
I will come back to the 3 months ownership. As you guys may be aware, we gave an operational update this morning that we just released to the market. So I'll come back to that point and give everyone a bit of a flavour for how we're tracking after the first quarter. I think this slide is the importance of this slide sort of comes out of nowhere, really. But I think from one of the key sensitivities that Mick and I sort of heard during our fundraise process as we were trying to acquire this mine was a lot of anxiety around SPACs as a structure and SPAC performance, particularly with a lot of names in the past, albeit the fact that it's very rare for SPACs or mining SPACs to have actually found transactions or closed transactions. But on a broader scale, there was a lot of anxiety around trading post-close and what the ramifications of that would be. And as you can see on the slide, we've tracked incredibly well post-close. Now, the large driver of that is twofold. One, we were fortunate enough to be able to sort of put our own register together of shareholders that we have strong relationships with, who backed us and backed the story, and have a long-term view on both the commodity and on the company. So that was incredibly helpful in providing that stability on the register. And then the second reason, frankly, from my perspective, is having relationships with guys like Osisko, where we were able to structure a backstop through the copper stream, additional equity that allowed us to not have to embark upon taking any high risk sort of structures, if you like, in terms of a backstop that was largely driven by whether it be a convertible or other structure that was proposed to us. And that sort of gave us that sort of headroom post-close to focus on the operations and continue to make changes at the operations without having the concern in the background around, various issues around our capital structure. Now, this is a slide that I think one of the things that Mick and I, when we're presenting broadly to investors, we show it's more to sort of telegraph our view as we looked at this asset during diligence as to why we got excited by its potential. I think one of the things that really stood out for us is that if you look back, and I think we used to call this slide Back to the Future, actually, rather than the current heading, but you can see in the numbers in 2017 that this mine has actually performed at a very, very strong output and also significant grade as well. And largely as part of the sort of process in 2018 where Glencore decided that it would sell the asset, you can see that performance has really tailed off, and that was largely driven by, the classic scenario that a lot of us see in M&A, where a vendor decides to sell an asset and sort of loses focus on the asset over time and focuses on selling the asset. And you could see that certain changes were made at the mine over that period of time that led to sort of tapering off in performance. But the mine itself, from all the work that we did during the diligence process, definitely has the potential to revert back to those days in 2017.
I think it's probably noteworthy, Dan, also to mention that you can see the tail out there from when Glencore made the decision to sell the mine. However, since 2016, there's been major capital infrastructure improvements in the mine.
Correct.
Which basically gives us, an untapped opportunity, in particular reference to the mills. So, the mill capacity here, the latent capacity of the mills, you're looking at almost 2 million tonnes. The current output of the mine is around 1.1 million tonnes. So the opportunity is just phenomenal. Infrastructure programs like the underground cooling systems. We do have a unique opportunity here, and one of the only mines I've ever seen with 2 shafts. So we have latent capacity in both our shafts. I guess the moral to that story is that the mine's output now is in our hands. There's nothing really stopping us.
Absolutely. And I think, this is a perfect segue, as I'm conscious of time, obviously, as we're presenting, for Rob to give you some background on some of the changes that have been made since he's come on board in terms of headcount and various other aspects at the mine as well.
Yeah, thanks, Dan. I guess the operational improvements, and we probably reference it more so here on site around operational discipline. So the mine itself, coming into the mine, I came in late July, just after the transition from CSA. There's a notable difference, I think, in the management style from how Glencore and CSA used to manage the organisation. We've done some significant structural changes throughout the mine, and when I'm referencing that, I mean in the management. So that's had a significantly positive impact. We have had some changes, I guess, some structure changes throughout the organisation, and those were more tiered around delayering, so destructuring quite a cumbersome management, I guess, profile, if you like, from top to bottom. So that delayering has actually happened at this point in time. In terms of operational improvements, as I said a moment ago, we are positioned in a phenomenally good position at the moment. Underground, we brought in some new management people, I guess you could say, from other industries who bring, a wealth of knowledge with reference to operational outputs. Probably the most notable, change that we've implemented at the moment, like I said a moment ago, is the de-layering of the organisation, which has basically lifted and boosted morale across the group, and it's quite notable at this point in time. There's more coming, more to do, but like I say, our infrastructure and Glencore are very favourable to us since 2016.
Yeah.
We have a significant opportunity here, which we're going to run with.
Yeah, and I think that's a key point. I think we sort of benefited from the fact that in 2019, Glencore did attempt to sell the mine. Found it very difficult to sell because at the time, because obviously there was a need for further investment and capital investment to provide the incentive, and obviously a lower copper price as well did not help matters during that process. But the decision was made to invest considerable capital in the mine to get it to improve a number of these metrics that we're looking at from a long-term perspective. And obviously the copper price recovery and robustness over the last couple of years on the back of the decarbonisation thematic helped that as well, drive it into that process, which we've been very fortunate to have stepped in at this point in time. So we effectively on day one, from a financial perspective, we have no development capex that we need to invest in. There is, all the capital works have been completed. Vent has been upgraded. There's a new mill in, and from our perspective, it's just the ongoing sustaining capex, and then obviously working hard to get those extra development meters out in the mine to sort of drive productivity, because we know, as Rob said, the infrastructure can absolutely support more ore coming out of the mine. And actually, interestingly, in July, we had some stockpiles that we processed through the mill, and we actually managed to achieve 1.45 million tonnes through the mill for the first time as a run rate, which was the first time in probably ever in the mine, probably the highest that it's been. So the infrastructure can do it and has the capacity to do it. Now the focus is very much focused on improving productivity in the mine, debottlenecking and improving the productivity. I think that's probably a good opportunity to open it up to Q&A. I think, I suggested to Mike and to the Osisko team that it was a good idea to have Rob on this call, because it is very rare for investors and analysts to have exposure to the GM at the mine. I think it's a great opportunity for the room to ask any questions with Rob being on this call presentation today. So happy to hand it over to the room and answer any questions that you may have.
So Dan, we're just going to pass around a couple of mics that you guys can hear.
Hopefully. We will listen intently and very closely to our screen.
Hi, thank you so much for taking the time to give us an update on your asset. I just want to ask about the underground development. You mentioned that you've got to push that underground development. Can you talk a little bit about what needs to be done and when you think you'll have the appropriate development to feed the mill? Are we like 6 months away, or what do we have in terms of development ahead of production right now, and where do we need to go? Thank you.
I think just at the outset, you'll see a notable difference in lateral development underground in Q1 next year, so Q1 24.
Yeah.
Now, we mentioned a moment ago around that debottlenecking. So unfortunately, there's been decisions made in recent times here at CSA around stopping development in certain areas. Now, the actual big bottleneck that we have at the moment is ventilation, and the mine itself is not intake constrained, it's exhaust. So at the moment, we're previously running around trying to get our exhausts in place so we can ventilate these areas in the underground development workings to enable us basically to get back to what you would think is a common run rate with lateral development.
And when's the ventilation going to be optimum to meet the underground development and everything else you need to do?
It's an ongoing program, so it's not going to end. As we go deeper, obviously we're going to, out on strike, we'll be putting in different ventilation shafts internally to stage the vent coming down through the mine. But in terms of just seeing lateral development come back to where it is required, I guess, to bring the mine forward, we're looking in Q1 next year. So at the end of Q1, we theoretically should have the ventilation strikes in place to kick off the lateral development back where it needs to be, the requirement of the output of the mine design.
Yeah, and I think that's a key point. I think in terms of that is with reference to the development that we want to achieve, the development rate that we want to achieve. I think if you look at our Q3 update that we gave today, you'll see that there's been a marked improvement in development, both on a cost per tonne basis and both in a metres basis as well. But what Rob is referring to there in terms of our plan and what we actually want to get to as a run rate and get our development up to in terms of Mick's very lofty standards and ambitions, as you all know, for those in the room that know Mick very well, that is probably something that we're targeting in Q1 next year, early Q1 next year, or whatever you want to say, in the next couple months. But that very much is the focus on the development front.
It's probably relevant to also say we're looking at different technologies in the way that we drive these ventilation rises themselves.
Yeah.
We've got a couple of options here on site. We're basically exploring at the moment to expedite that process itself. So as soon as we can get that ventilation shafts and the drives in, we'll be doing that.
Any other questions? Maybe Dan, one from me is can you talk about the upside potential? I think there was a few things you guys mentioned in your press release this morning in terms of next steps for you guys for upside.
Yeah, look, one of the things that we were very fortunate as part of the transaction to sort of inherit on the back of this asset acquisition was that there has been significant drilling done broadly over time at the mine, both in mine and both around the mine as well. So from our perspective, we're just undertaking a resource and reserve upgrade exercise that we're embarking on and trying to get out for Q1 next year, which it's a combination of things. As some in the room may be aware, we renegotiated the offtake on this asset with Glencore to be a market benchmark offtake relative to the previous offtake, which was it was a unique offtake in a lot of ways because it was struck at the time that Glencore had acquired this asset through a prepayment 20 years ago, so had price participation and various other metrics in there that forced the cutoff of the mine to be much higher than it really needed to be from an economic standpoint. So dropping the cutoff grade, also looking at the uppers in the ore body, so the sort of material above, closer to surface that's above the current mining area where there's still significant grade that historically was not mined, and various other sort of areas that drilling shows as highly prospective should lead to material upside for us over time. And that upside's twofold. It's not just upside just from an economic perspective and ability to access more areas in the mine and actually take a lot of pressure off the bottom of the mine, which we've been doing for the past 3 months and will continue to do, and open up a lot of other areas further up in the mine to take pressure off the bottom of the mine. But it also is quite important from a sort of financing perspective as well over time, because one of the key constraints we had as we were funding the transaction initially was that there was a relatively short reserve life here, limited our ability to sort of get financing from senior lenders in particular, on the basis of the short reserve life, and over time, as we increase the resource and the reserve, that also opens up opportunities to sort of rework our sort of capital structure and balance sheet, simplify our balance sheet by moving through with our lenders and working off a longer life mine. And again, that in itself opens up a number of opportunities also on the sort of incremental capital front in terms of exploring new ore bodies and getting QTS South up and running and some other areas that are of interest to us.
We have one more question here, Dan.
Sure.
Thanks for the presentation. Dan and Rob, can you talk about where your exit rate on mining cost per ton was coming out of Q3, and if productivity and debottlenecking enhancements go as planned, where do you think the savings are and what you can get that number down to?
I'll take this one. Yeah, no, look, I think in terms of our mining costs, we managed to get our mining costs in Q3 down to $79 a ton from Q1 and Q3, which was well above $90 a ton. We've got the benefit at the moment of two things. We obviously made significant changes at the mine in terms of not just headcount, but also in terms of as Rob alluded to earlier, in sort of that delayering and debottlenecking and focusing on productivity, which has driven a lot of that sort of cost coming down. And then obviously we are not going to not state that we have had the currency help us a little bit here as well. We're Aussie dollar denominated largely, our costs, 80% fixed costs and largely in Aussie dollar, which is having a tough time at the moment. Where we get to, look, I think from a realistic perspective over the next 12 months, I think if we get into the sort of sub $70 US for mining costs, that looks good for us. That works very well. I think the sort of, as you well know, the counterbalance is always getting your costs low, but then also what are we doing in terms of output and what can we get in terms of output? And largely we're quite fortunate in the fact that as it's mainly a sort of fixed cost environment for us at the mine, and there's a lot of installed capacity already and no need for incremental capex. Really, if we can get that development moving in the right direction and we can get productivity improved, then you'll see a significant downward pressure on mining costs and costs across the board as well.
All right. Thank you, gentlemen. Appreciate your time today. I know it's early for you guys, but appreciate you guys taking the time for us.
No, look, no problem. And look, I appreciate that you've invited us onto the call and that we've been able to present despite not being able to make it over for the day. We definitely value the partnership we have with Osisko, and as we always discuss quite regularly, we look forward to doing more transactions in the future as we grow the company. And it's not something that we discussed in great detail today because I wanted to focus largely on CSA and giving everyone a flavour for what we're doing at the mine and at the task right in front of us. But we are looking at a number of assets more broadly in the space to continue to sort of add and grow this business of creative fashion with a lot of discipline, not growing for growth's sake, but we're in a very, very good, interesting sweet spot here as a company at the moment, being focused in this region and in this area, particularly in Australia, with a number of the mid-cap companies largely either having assets offshore or focusing on precious or other areas. There is a real opportunity for us in this market to use CSA as a sort of foundation asset to grow this business into a multi-asset business. And we're definitely looking forward to having Osisko along for the journey as well. So appreciate the time today, guys.
Yeah, thanks very much.
Thank you.
Thank you.